3 huge mistakes you may be making with your retirement funds and how to fix them. My name is Maki. I'm a financial advisor at Strategic Financial Group. Here at the firm, we've seen it time and time again where somebody is making really good money in their career but feel as if they're stuck in not making any progress in their retirement funds. Today, we're going to look at 3 common mistakes we see as financial advisors and how we would suggest fixing them. Again, this is general advice, not for everybody. Really, meeting with a professional is one of the best ways that you can get yourself back on track. The first mistake that we see is confusing wealth with cash flow. A lot of people assume that if they're making a high income, they're automatically building wealth, but income does not always equal progress. Imagine that you're making $150,000 a year. That's just your income. That doesn't include your spouse. If you have one, that's just you. For a lot of our clients in Western Michigan, $150,000 a year is a lot of money. It's a very high salary, but it's not unheard of. If you're making $150,000 a year in Western Michigan, you're making a pretty good salary. You're well above what most people make. However, we cannot focus solely on salary when it comes to wealth. If we allow lifestyle creep to take hold of us, that $150K, it's gone very quickly. Very easily, we can allow ourselves to start buying nicer and nicer things, start buying new cars every couple of years because we think we can afford it. And in the meantime, we're not actually saving up our retirement funds. Lifestyle creep can take over very quickly. If you are still in your accumulation years, meaning you're saving for retirement, then that $150,000 a year needs to be serving multiple purposes. First, it needs to be used to allow you to live, right? That means paying your bills, feeding your family, and paying off your debts if you have them. It also means that you have a job and that money has a job as well of saving for your future. Every dollar needs to have a job. If it doesn't, it will disappear. This is best achieved through a budgeting app. You can't get away with anything with a budgeting app. It will tell you if you are spending too much. A lot of people, they look at their account balances, they see them get to a certain level, and they become comfortable. And while this is important, we also need to switch our mindsets to tracking cash flow as well, not just account balances. I would also encourage you to set some goals, right? What do you want your emergency fund to look like by the end of the year? What do you want your retirement funds to look like in 10 years? Goals help us stay on track and use our money wisely. But it isn't just about setting goals for now, but setting goals for the future as well. We need to make sure that we're building assets that produce income later on so that we can have that work optional lifestyle. That means that if you are saving, which you should be, you'll want to make sure that you're investing too. The younger you are, the more wealthy you are when it comes to time, right? The more time you have in the market, the wealthier you are, even if you have less money than others, because you have a greater potential to make more over time. The second common mistake that we see is ignoring taxes in retirement. A lot of people think that their taxes will go down in retirement. And this is true for a lot of people because they're spending less, but that isn't always true for everyone. If you're making and living on $150,000 pre-retirement and you want to keep that budget in retirement, which a financial advisor may encourage you not to do depending on your asset size, then your taxes probably won't change all that much if everything is coming out of your 401k and or your traditional IRA. And the picture gets even more complicated if you look at delaying Social Security. It gets more complicated when you hit RMD age, that's your required minimum distribution, or if you decide to start paying some of your taxes early and converting your traditional IRA to your Roth IRA. The picture can get really, really complicated when it comes to taxes. There's a couple of things we can do to avoid this mistake, or at least alleviate some of the pain, because taxes can be painful, right? We can diversify our tax buckets, right? That means that if you have a combination of different types of accounts, you can save on taxes. Your 401k, your traditional IRA, they're taxed the same for distributions. That means that when you take money out of them, you're going to be taxed. But a Roth IRA, you pay the taxes when you put the money in. And that means when you take the money out of the Roth, it is not going to be taxed. So on certain years, if you have some emergency expenses come up, you may save some money by dipping into your Roth on those years. Even having a brokerage or a non-qualified account may be helpful for some. In a non-qualified account, you're taxed whenever you take profits. So say you have a stock that you bought for $100, it rises to $150, and you sell it for a $50 profit. You're taxed not on the $150, you're taxed only on the $50 profit. The catch is, you're taxed on that $50 whether you put it into your bank account or whether you reinvest it in your non-qualified account. Either way, you're taxed on the profit. However, for the year 2025, if you're married filing jointly, the tax rate on that $50 is 0% unless you make over $96,700, and that's before the standard deduction. The point is, when you have all these different types of accounts playing together, it can get pretty complicated, right? I mean, that was complicated stuff. You may be an expert in your field. And if I walked into your office at Herman Miller where you're designing an ergonomic chair or drawing up a new desk that rises and lowers, I would be confused about the complications of how a chair and the human spine play together. You're the expert. We're the expert in this field, and we make sure that all of these accounts play together nicely. If you're starting to wonder about maybe diversifying your types of accounts, it may be time to start talking to an expert. Another way you can help with taxes in retirement actually makes you pay more taxes early on, but maybe pay less later on. Making Roth conversions early on in your retirement journey is a way to pay taxes now so that you don't have to later on. We make no guarantees about this, but when we're looking at the national debt of the United States, we recognize that eventually the bill is going to come. Eventually, we're going to have to start paying this stuff down, right? And at that point, there's two major ways to pay down the national debt: raise taxes or cut funding, or a combination of the two. And we've seen kind of how cutting funding works in the past. It just means that somebody else gets the money. So really what we're seeing is that there's probably going to be higher taxes in the future. We believe this, and a lot of our clients do as well. And for this reason, some of our clients are paying the taxes on their traditional IRAs now and converting them into Roth IRAs a little bit at a time, every year, just a little bit. And so that way they're paying taxes now so that they won't have to pay taxes later. The third mistake we see is not having a clear retirement income path. Again, you could be making really good money in your career, but if you don't have a plan, that money will soon depart. A fool and his money is quickly departed. A failure to plan is a plan for failure, we say pretty often. However, this mistake goes beyond the accumulation years and also addresses your retirement years as well. We've made videos in the past about having a number in mind for your retirement and focusing on a dollar sign goal. We believe that that's a good thing, but you can't just stop there. You have to understand how that money will be used in your retirement as well. Somebody who has $10 million can easily outlive their retirement funds if they do not have a plan. It can disappear very quickly. Budgeting does not stop when you're in retirement. So to avoid this, we have to make a plan. You have to ask yourself, how much annual income do you want? And where are we going to get it from? What guaranteed sources do you have, like Social Security? Do you have a pension? What do your portfolio withdrawals look like over time? And then we take those numbers and we stress test it. What happens if inflation is higher than the national average? And what happens if at that same time, while you're taking money out, inflation is rising and you're not getting the returns that you expected? These stress tests can be stressful themselves, but often we can better understand how we need to plan for the future beyond just using a 3% or 4% withdrawal rule. We can start to understand the full picture. So let's recap. 1, don't confuse your high income with progress. 2, don't let taxes sneak up on you. And 3, don't head into retirement without a plan for how you'll actually live on your money. A lot of the solutions for today come down to 2 things: budgeting and planning. If you're not sure how to start that conversation and how to start that planning, then that's where a professional like myself comes into play. At Strategic Financial Group, we believe in our motto, which is plan smart, retire smart. If you're ready to move from feeling unsure to feeling confident, I'd love to chat.